Gold has been one of 2025's best ETF trades. Some gold ETFs give you direct exposure to the metal itself. Others give you exposure to gold miners, which are companies digging for it, and their profits rise and fall based on gold prices and, of course, how well they do in terms of the discovery. So today's audience requested ETF matchup is a face-off between physical gold and gold miner ETFs. So who wins the battle and when is the better choice? Stick around for the answer. Well, this is ETF Battles, and I'm Ron DeLegge, and warm welcome to all. Hit the like button if you've been enjoying our program, and of course, join our community. For those of you that are new to the program, new to our channel, subscribe. We're almost at 60,000 subscribers, and a big thanks to all of our loyal fans. We could not have done this without you, and this will be our last program for Season 6, 2025. And we're so glad that you've joined us on this journey. It's been a great year. Be sure to visit this comment section below. Let us know how you've enjoyed the program. Also, if there's a certain ETF contest that you'd like to see, send us your ticker symbols. You could do that, again, in the comment section below or on our X feed at ETF Guide. Also, check out the description section. We've got links to our program sponsor, Direction. We've also got links in that same description section to our online courses. We now have 3 courses that are completely free to all of our viewers. The idea here is to help you upgrade your investing skill set. So today's ETF contest was recommended and suggested to us by a viewer named Kep19901. He's a longtime viewer and fan of the program. He also goes by the name Keith, and it's a physical gold versus gold miners matchup. Which strategy is the better play? Well, let's ask our judges. We've got the best in the business, Athan Psarofagis with Bloomberg, and David Dierking with TheStreet.com. Great to see both of you. Welcome back.
Yeah, great to see you guys again. Thanks.
Hey, nice to see you guys.
So we've got our 4 battle categories: cost, exposure, strategy, performance, and mystery. For the mystery category, our judges can choose any factor or thing that they feel is crucial to today's contest. They can also opt for split decisions. They can nominate wildcard ETFs. We'll just have to see what they come up with. I've got the scorekeeping chores, and at the end of the program, we will declare an overall winner. Keep in mind, none of the battle outcomes on this program are ever predetermined or known in advance by myself or our judges. So let's kick things off with the first category, cost. Dave, please get us started.
Yeah, I'm definitely going to be throwing out some wild cards in this category. GLD and IAU. GLD comes in at 40 basis points. IAU is at 25 basis points. So if you're looking at just those two, the iShares product is going to be the winner. But I think if you're a retail investor, you definitely want to go with the mini shares versions of these funds. So that would be IAUM. For iShares, it comes in at 9 basis points. GLDM from Spider is the mini shares version of that fund. It comes in at 10 basis points. Since they all invest in physical gold, there's really not much reason to not go with the cheapest option in this category. GDX is at 51 basis points. That's a whole different beast that we'll get into in a moment. But as far as just going with the cheapest product here, I'm going to go with IAUM as my winner, the mini shares version of the iShares Gold ETF.
Thank you, Dave. That's a strong start. Athan, you're up next. How do you see it when it comes to cost?
Well, we're on the same wavelength, Dave, because I was thinking about the other mini versions. So there's a GLDM and IAU, Mikey had mentioned. Without breaking those in, let's just look at what we have here. Obviously, 40 basis points, like you mentioned, for GLD. This is the default vehicle for everyone. When people think about gold, they just go to GLD. That's why it's got 143 billion in assets. IAU's got 66, even though it's more expensive. Just sometimes investors just tend to gravitate towards one product or one ticker. GLD's been around for a long time. One, I think, difference that why not only is it why that is cheaper at 25 basis points, so I'm going to give it to IAU. The other thing to keep in mind is the actual price handle of the ETF, meaning you're going to pay $380 or so for GLD and $79 a share for IAU. Sometimes that's important to people if they want more shares, if it's getting put into a model, things like that. So the lower price handle, which also the mini products that David had mentioned also alleviate that. But just because of the lower expense ratio and the lower handle, I think this is an easy pick, IAU.
That takes us next to exposure strategy. Ethan, you're still up. Give us your analysis.
Great. So GLD and IAU are pretty much exactly the same thing. If you run performance over the long term, they're giving you exposure to gold spot. Now, if you care about how the gold is being sourced, right? You can they're both being housed in London. One has HSBC as a custodian, that's GLD. The other one has JP Morgan. Pretty much the same thing. I think a lot of investors don't necessarily, not that they don't care, they don't get into that level of depth. They're both obviously secured by actual gold in the vaults. The GDX, which is the VanEck product, that's a completely different animal. That's gold mining stocks. The only reason I'm going to screen out GDX is I think if you're going to be buying gold, a lot of times you want to buy it as a hedge or some sort of uncorrelated assets. When you have GDX in stocks, you're obviously much more correlated to the market. So this one's basically kind of a tie, to be honest, because they're really doing the same exact thing. They're both giving you really good, efficient exposure to gold spot. It's better than the futures-based product. So really a tie for me between GLD and IAU.
David, you're up next. Give us your analysis on exposure strategy, please.
Yeah, as Ethan alluded to, this is kind of a, very much an apples to oranges comparison here, because with the gold miners, you're looking at stocks, so you're exposing yourself to operational risk, earnings, revenues, that whole type of thing when it comes to investing in really any kind of stock. So if you look at the historical volatility because of that added risk, GDX, or really a lot of the gold miners, are more than twice as volatile as just physical gold. So that should be a consideration as well. The gold miners are really just kind of a leveraged play on gold. They're correlated to gold, but there's so many other factors that go into it. It's kind of an entirely separate asset class. So looking at GDX specifically, I looked at a couple of other similar miner ETFs. I looked at the Sprott Gold Miners ETF, SGDM, and I looked at the iShares Global Miners ETF. The ticker symbol is RING on that one. Very nice. Within those three, I would still stick with GDX. I tried to get to the other two, but they're really top heavy. Ring in particular has about 40% of the portfolio in just three miner stocks. So it's really, it's very concentrated, very top heavy. GDX is a little more spread out, at least. So I think as far as the diversification standpoint, I think GDX is better than the other gold miner ETFs. But again, it's tough to really compare gold to gold miners since they're so different. So I agree with what Ethan said. I think most people are trying to use gold as a hedge of some sort. So I would lean towards the physical gold ETFs. I chose IAUM, the iShares mini shares version of the gold. I'm going to choose it here. Again, IAUM is my winner.
That takes us next to performance. And you're still up, David. So break it down for us. How do these ETFs compare?
Yeah, again, GLD and IAU, the performance is virtually identical. Everything about these is virtually identical outside of the fee level on that. So because IAU has the lower expense ratio, over the long term, that's going to come out a few basis points ahead. So between those two, there's probably a slight advantage there. If you look at GDX over the last 10 years, it's about 50% greater return. If you look at the physical gold ETFs, they've made about 14% a year over the last 10 years. GDX is around 20 to 21% a year. Most of that obviously has come in the last year or so. But again, it gets back to this point of risk-adjusted returns. With the gold miners, you would have got a 50% greater return, but you're also taking about 150% more risk to get it. So is that worth it? Depends on what you're looking for. Some people just prefer absolute returns instead of risk-adjusted returns, so they're okay with that. It really depends on what you're looking for. But this is a case where I would probably give it a split decision between all three of them, because I think as far as physical gold and gold miners, you can really use them both together. You can get physical gold for kind of the hedge, and you can get GDX as sort of the gold correlated outperformance potential, I guess you could say. And that would be potentially give you a little more juice in your returns. And because you're investing in stocks versus gold, there's really a big difference between what you're investing in. So I guess I'll call it a split between all three of them, just because I think you can really use physical gold and gold miner stocks together in your portfolio.
Ethan, you're up. What is your take when it comes to performance?
Yeah, that was great, and I can't argue with GDX's performance over the long term. Like I said, it's completely crushing GLD and IAU. But I think we've done some research here, not to make like a shameless plug for our research, but if anyone's interested, let me know. But it's about performance when the market is down, and this is what we look at is like, yes, you can compare it to the S&P, but I wanted to see how GLD or even Bitcoin perform on down days, right, in the market. And actually GLD is a pretty decent hedge. It's never perfect, there's no such thing as like a perfect hedge, but it tends to do really well when the market is down. So I liked its behavior as a hedge, and that's why I'm thinking someone would want to own, GLD or IAU. So even though, yes, it doesn't have the strongest absolute performance relative to GDX, I like it when I need it, and this is why I think GLD is such an attractive, or one of the other two. So it's kind of a tie. If I just don't have another split decision, I'll probably just pick IAU because it's a cheaper option. They're both going to behave exactly the same. You might as well just pick the cheaper of the two. So for performance, I like it when you need it, and this is where I think the actual gold spot steps up in its role as a portfolio hedge.
My late grandma said it's better to have it and not need it than need it and not have it.
That's true.
That sounds to me like what the good advice that Ethan just gave us. So that takes us next to the mystery battle category. This is where our judges give us that certain factor or thing that they feel is crucial to today's contest. So Ethan, what is your mystery battle category, and which of these ETFs takes it?
Man, taxes can't escape the tax man, unfortunately. And so one thing to keep in mind about these spot gold ones, to the government, they're taxed as collectible. So what that means to you is it tends to carry a little bit higher tax rate. So they'll view these as actual gold, not like equity or cap, or so you're going to get a different rate. So they tend to be taxed up to 28% relative to some of the more favorable capital gains rates of like 15 or 20%. So they are taxed a little bit higher if it's in a taxable account, meaning the gains on that. There's no dividends, obviously, but if you sell them and whatnot, when it comes time to pay taxes, you're going to be paying a little bit of a higher rate. So GDX doesn't have that, right? They're not taxed as a collectible. Again, it all depends on your tax situation. But let's just say from a tax perspective, GDX avoids all that just because it's stocks. So I'll probably just give this to that just because it's not taxed as a collectible because it's actual stocks. So I'll give this one to GDX.
And you're up next, David. So break it down for us. What is your mystery battle category, and which of these ETFs wins it?
Well, honestly, I was going to talk about the price handles on these funds as why the mini shares or even IAU is a little more advantageous from a tradability standpoint. But Ethan took that from me right off the top here. So I'm just going to, there was one other thing I just wanted to touch on, since we're in sort of the mystery category. A lot of people view gold as a defensive hedge or like a downside stock market hedge or even an inflation hedge. And I think if you look over the long-term course of history, gold really has almost no correlation with stocks whatsoever. So that basically means that can it work as a downside hedge? Maybe, maybe not. Can it work as an inflation hedge? Maybe, maybe not. The only real consistent relationship with gold to stocks has been if there is sort of a hyperinflationary environment where inflation goes up to like 5-10% or higher than that, that's when gold really serves as a defensive hedge. That doesn't happen too often. So outside of that, gold is one of those assets that can really go up and down on its own. And because it has really no correlation to stocks, that makes it a good volatility hedge more than anything. So if you're looking to just lower the overall risk level in your portfolio, gold is a great tool to do that. Whether it can add return to your portfolio really depends on the environment. Over the last couple of years, obviously, you would have done great some years not so much. So I just want to point that out as far as what investors might want to expect when they're investing in physical gold. It should work as far as reducing volatility in your portfolio. Will it work in a down market or an inflationary market? Maybe, maybe not. So just to kind of set expectations there. But as far as picking a winner, I was originally going to go with IAUM and the price handle thing. I think as far as judging gold versus gold miners, I like physical gold here as well. It still works very well as a hedge, just as long as you know what you're getting. So I'll go with IAUM as the winner in this category.
All right. Well, that takes us next to the part of the program where our judges can give us their overall battle winner. So, Dave, give it to us.
Yeah, overall, I kind of view this battle as what people really look to gold to do. And I think for the most part, they use it as a hedge in their portfolio to either reduce risk or they want to try to provide sort of a defensive counterbalance to equities or even bonds. So I think in that sense, I would probably choose one of the gold ETFs over the gold miners ETFs. I've gone with IAUM throughout this battle just because I think it does the best job of providing the cheapest exposure to gold. I think that's probably going to serve investors best over the long term. Just going with the cheapest option here. So I'm going to go with IAUM as my overall winner in this.
Your final chance, Athan, to weigh in with your battle winner. Whom among these ETF tickers will it be?
Well, I'm going to echo the same thing. I was going to bring in the wild card pick just because even though GLD is 40 basis points, GLDM is 10. It's a quarter of the expense ratio. To echo what you were saying, I also just like gold spot relative to gold stocks in your portfolio. So if you're going to do it, you want to hold it for the long term, just buy the cheapest one. They all have got sizable assets. They all trade really well. They're all backed by big issuers. So I think really if you pick any of those four, you're fine. But you might as well just go with the cheapest one. So I also like IAUM because it's 21 basis points cheaper than GLDM. It's brutal out there how competitive issuers are, but I think that's the one I would go with as well.
Well, our judges have spoken, and today's ETF battle winner in this gold showdown is IAUM from iShares. That's the Gold Trust Micro. And that one, as our judges pointed out, has the lowest expense ratio. It also gives you that efficient exposure to physical gold without having to take custody. And as our judges pointed out, a few potential caveats: higher taxes, right? If you've got a capital gains tax, if you're holding this in a taxable account, you're going to pay a higher capital gains rate for any type of physical precious metals exposure just because it's treated by the IRS as a collectible. So keep that in mind. You do have a little bit of an advantage with gold equities, which GDX is. But again, that was pointed out by our judges. Also, I thought Dave's point was great too, is maybe you own a little bit of both. Does it have to be one or the other? I mean, you people are so extreme. So maybe it's a little bit of both. And certainly the longer term performance, when you look at it, certainly favors gold equities, mining stocks over physical gold itself as far as bottom line performance. But again, we don't know what the future holds, but we do know that when markets get rocky and stocks go down, then you start to see some of these physical assets like precious metals perk up. Great job to both of our judges. And we really appreciate having you, not just on today's program, but on our season 6, all of 2025. It's been a great season. And again, we wish you both the best of success. We thank you also for your great analysis, both of you.
Yeah, thanks so much, Ron. This was really fun.
Yeah, appreciate it. Always good to be here.
Be sure to hit that description section below. We've got links to our program judges. Get in touch. And we've also got links to our program sponsor, Direction. Lots of choices as far as ETF trades. We talked about gold. You got some choices there in Direction's lineup for leverage exposure to gold miners. So hit that link to direction.com in the description section below. And also keep your ETF battle suggestions coming. We've had some great matchups this year. We could do double, triple, and quadruple headers. Send me your ETF ticker symbols in the comment section below. You can also send them on our X feed at ETF Guide. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you soon.